Hello everyone, welcome to video 3 of Indian Economy Advanced series titled Money and Inflation. Now the recommended readings for this video is chapter 6, that is the chapter on money, and chapter 7, the chapter on inflation from Indian Economy Handbook. Now let's get started. Now we'll start with looking at the money supply trends in India. Now you must already know that reserve money or M0 is the money injected by RBI into the economy. And then we have different measures of money supply, that is M1, M2, M3, and M4. M1 is generally known as narrow money, and M3 is known as broad money. And narrow money and broad money are the two most tracked measures of money supply by the RBI. So if you look at the trends, so as expected, the reserve money has been growing. At the same time, the narrow money, which also includes, apart from cash in circulation, it also includes the demand deposits in the banks. So its value is going to be slightly higher than the reserve money. So the narrow money has been growing. And then the broad money, which includes both the demand deposits as well as time deposits in the banks along with cash in circulation. So its value is much higher than narrow money. And this has also been growing. So this is proof that the Indian economy has been growing at a fast rate and also indicative of more uses of banking facilities by the population. So more and more population have access to bank accounts and they are using digital payments and UPIs. So the money is getting circulated a lot from in the banks, and therefore we see a rising values of money supply, both narrow money and broad money. Okay, let's move forward to understanding the money multiplier. As you must know that money multiplier is money supply divided by reserve money. All right. So this you already know from the chapter on money in Indian Economy Handbook. Now we see why money multiplier increases in any economy. Okay. For this, let's say that there is a person A and this person A has a cash of 100 rupees. Okay. Now, in this case, what is the money supply? Money supply is the total cash plus deposits. Now, you see the cash is 100. There is no deposit in the bank as of now. So, the money supply is 100. Okay. Now, this person A deposits 100 rupees into a bank. So, now the cash with the person is 0 and the deposit is 100. So, there is no change in the money supply because now cash is 0 and deposit is 100. So the money supply remains 100. So the act of the person depositing money in the bank does not change the money supply. But if the bank gives a loan of this 100 rupees to a person B, okay, so now you see the person B has cash of 100 rupee, person A has a deposit of 100 rupee, and therefore the money supply becomes 100 plus 100, that is 200. All right. So as soon as bank creates credit and gives loan to someone else, it increases the money supply in the economy. Okay. Now suppose this person B lends 100 rupee cash to person C. Now again, this is an exchange of money that has happened outside of the banking system, and therefore you'll see that the cash with person B becomes 0 and the person C has cash of 100 rupees. So the money supply remains same, that is 200. Okay. Now this person C deposits the 100 rupee into the bank. So now the person C has deposit of 100. The cash is now no longer in circulation. The cash is with the bank. And therefore the money supply remains same. Cash in this case, sorry, the cash is 0 and the deposit is 200. So the total money supply is 200. Okay. Now, if the second bank gives a loan to person D of 100 rupees, then the deposits are right now 100 and 100. 200 is deposit and cash is 100, and therefore the money supply increases to 300. Okay. Now, if person D lends the money to person E, then again there is no change in money supply because this transaction has happened outside of the banking system. And the person E again deposits the money into the bank. So the deposits are 300. Cash is out of circulation. Cash is with the bank, and the money supply is 300. And if the bank again gives a loan to person F, then there is an increase in money supply because now there is a deposit of 300 and cash in circulation, that is 100, a total money supply of 400. So you understand that how with more and more banking habits of people, there will be increase in money supply in the economy. So although the reserve cash that has been injected by the RBI is limited, through more and more circulation of money through banks, more and more money supply will be created. Okay. Now, this is a very simplistic example. Of course, in real life, the things are going to be much complex, much complicated. And also here we have ignored certain things that is known as cash reserve ratio. When bank gets a deposit or some deposit, it has to set aside a certain amount of money as credit cash reserve ratio, and it can loan out only a smaller portion of the total deposit that it has. Okay. For example, in the very first transaction, if person A deposits 100, bank will have to keep out a percentage of that money as cash reserve ratio as mandated by RBI, and it can loan out only a fraction of that amount. So for example, if suppose the cash reserve ratio is 5% and the bank has received a deposit of 100 rupee, then it has to set aside 5 rupee as cash. It cannot lend that money, and the rest of the 95 rupees it can loan out. Okay. So that is really the one of the reasons why the money multiplier in any economy is not infinity, because if there was no such mandate of maintaining a cash reserve ratio, the bank would give out whole amount as loan, and this was create too much money supply in the economy. Okay. Now suppose person B gives money to person C but keeps some cash with herself, right? So person B has 95 rupee, had 95 rupees, she keeps 15 rupees and lends only 80 rupees to person C. Okay. Again, this person C will deposit money in the bank. Now bank will again keep aside 5% of 80 rupees or rupees 4 as cash reserve ratio and loan out only rupees 76 to person D. Okay. So you see that now the money supply is much less than 300 what it would have made, right? So the money supply is only rupees 271. And if the person D lends to person E, but again, he keeps some cash with himself and lends only suppose 60 rupees, the person E deposits 60 rupees in the bank, and the bank again has to keep aside certain portion of 60 rupees, 5% of 60 rupees, rupees 3 as cash reserve ratio, and it can give out a loan of 57. So you can see the money supply, which would have been rupees 400, is now rupees 328. And therefore, we understand one thing, that there are factors, two really big factors that influence money multiplier in any economy. One is the cash held by individuals and businesses in the economy. And second is the reserve held by the banks. So higher the reserve that the banks have to hold, lesser will be the money multiplier. At the same time, if the people who have taken loans from the bank or businesses and individuals in general, if they hold cash, that money will not be circulated through the bank, and therefore it will lead to decrease in money multiplier in the economy. All right, and therefore the money supply will decrease. Now, this is important because here we see the trends of money multiplier in the Indian economy over the years. And you see that the money multiplier, the broader trend is that the money multiplier has been increasing. And this is expected also because as more and more proportion of the population engage in banking activities, they deposit their money in the bank and they use digital payments and UPIs. So the money multiplier in the economy will increase. But at the same time, you see some artificial increases. For example, during this time period, okay, so this is the time period just after demonetization, and a lot of people have deposited money in the bank. Okay, so the deposits have increased and the cash in hand is much less, and therefore the money multiplier has shot up. At the same time, if you see this period, right, now, this period is the COVID lockdown period where people have preferred to keep more and more cash at hand. They don't want to deposit their cash in the bank because they fear that the economy is going to go into a recession and maybe some of the banks may become bankrupt and they may not be able to take out their own money. Okay, so more and more people kept cash in their hands, and therefore these here you see money multiplier decreasing. But overall, the broad trend, again, it has picked up, and overall, the broad trend has been towards more banking, more uses of banking services by the population, and therefore increase in the money multiplier in the economy. All right. Next, let's come to inflation. And inflation, first we'll see the trends of global inflation, and then we'll come down to domestic inflation. Okay. And if you see the broad trends of global inflation, the global inflation was hovering at around 3.8%. Here you can see the global inflation was around 3.6 to 3.8%. But just after the COVID, you see, during the COVID period, obviously the economy all over the world experienced a shock. And after COVID period, when again the lockdowns were removed, you saw that there were significant supply side constraint, bottlenecks, breakdown of supply chains. And because of these reasons, therefore, there was an increase in inflation around the world. Okay. So the inflation increased. And this period also coincides with another major event in the world economy, that is the Russia-Ukraine war. So the Russia-Ukraine war also led to a lot of breakage in the global supply chains and rise in the prices of oil and all that, and that also influenced the global inflation. But since then, the global inflation has been coming down. So this is the broad trend with respect to global inflation. Okay. Now, let's see what have been the major drivers of global inflation. The first one we have already talked about is the Russia-Ukraine war. Now, because of the Russia-Ukraine war and because Russia is such a large supplier of oil around the world, it led to increase in the prices of oil and also the breakdown of global supply chains. And this was also the route through which a lot of commodities, mainly agriculture commodity, was exported, and this led to increase in global inflation. Okay. The second reason, major reasons for drivers of global inflation is the tensions that you see in the Middle East, particularly with respect to Israel and Iran. We have been seeing a lot of tensions, Israel-Palestine conflicts and all that. And this is particularly important because the Middle East is a major supplier of crude oil around the world. So if there is any war or any conflict happening in this area, it raises the price of oil, and which witnesses a ripple effect around all countries. India is a major importer of oil. 85% of our crude oil needs is met through imports, and therefore, any wars or any conflict in major oil supply areas leads to an inflation. Okay, so these are the two major reasons. Then again, one of the big factors of increase in global inflation is seen because of disturbances in the Red Sea, particularly the Suez Canal. Now, Suez Canal is one of the choke points of the world, and a lot of trade passes through the Suez Canal. Now, in the past years, here you see the trade route that passes through the Suez Canal. In the past years, you see that there have been a lot of Houthi attacks. Now, Houthi are the other rebel groups in the Yemen, and they have been attacking the commercial ships in this area in the Red Sea. And because of this, a lot of commercial ships have to reroute through Cape of Good Hope, and this increases the time period for trade. It also increases the cost of insurance, right? It also increases the cost of fuel, and because of these reasons, there has been more inflation around the world. So as you see, this increases the total time period of trade by more than 12 days. Another reason has been on the another choke point of global trade, that is the Panama Canal. Now, because of climate change, and Canal is very unique in the way that it has a lock system through which the ships pass through this canal. And because of climate change and because of unpredictable weather events, there has been droughts, not enough supply of water in these locks of Panama Canal, and because of that, many of these commercial ships has been stranded, and the global trade has been affected. So this is also one of the major reasons for increasing global inflation. Okay. Now, another major reasons I want to talk about is the synchronized monetary tightening that was witnessed across different major economies. So here you see that just after the COVID-19 pandemic, there was very high inflation, particularly the developed economies of Europe and United States. And because of that, the central banks of these countries increase the interest rates a lot. Okay. So you see very steep rise in the interest rates. And because of this, although through this they have been able to bring inflation under control, but the repercussions of these high interest rates was seen across different countries, and particularly the developing countries like India. And because of this, there was a lot of capital flight from India, because the global investors, the foreign direct investors and foreign institutional investors, they found better returns in these advanced countries, particularly USA, and therefore they were more willing to park their money in the USA and invest in dollars rather than investing in the Indian economy. So synchronized monetary tightening is also one of the major reasons which has influenced global inflation. Okay. Another reason of global inflation, of course, is the crude prices. Okay. Now, this is the trend of the Indian basket of crude prices, and India imports from various countries. It has diversified its import basket, and it imports from various countries, and a weighted average of that is taken, and this is the trend of crude prices. And as you can see that during the COVID-19 period, of course, this was the period where the demand really dipped. So therefore, there was a decrease in prices of crude. But after that, the price of crude has increased, and particularly due to the Russia-Ukraine war, the price has increased a lot, and also due to the Middle East tensions. Now, if we see which are the major reasons from where India is importing oil, and as we have already discussed, India imports 85% of crude oil needs. So we import 85% of our crude oil needs. So we are majorly dependent on imports. The major reason is Russia. From Russia, we import nearly about 35% of our total imports. Then it is Iraq, from where we import around 20%. Now, these are very rough numbers. Of course, it keeps on changing month to month. So you don't need to quote these percentages, but you understand which are the major partners of India with respect to import of crude oil. Okay. Then Saudi Arabia, around 13% of our crude comes from Saudi Arabia. From UAE, around 9%. And then USA, the role of USA with respect to crude oil has been growing, so around 4%, but slowly this percentage has been increasing. Okay. So from USA, we import around 4%. So these are the major partners of India with respect to crude oil imports. We used to import a lot from Iran also, but subsequent to sanctions on Iran by USA and other European countries, we have reduced importing from Iran. But from these countries, we import majority of our crude oil. Okay. All right, next, let's come to domestic inflation and let's see the trends of domestic inflation. And as you must know, that as per the mandate of RBI tries to keep the domestic inflation between the band of 2 to 6%. So between these 2 to 6% band, RBI tries to keep the inflation, and the 4% inflation is considered ideal for the economy. Now, as you can see the trends since 2019, most of this period we have experienced an inflation which is slightly too much higher than 4%. And at various points, we have also surpassed 6% inflation, and this is where we come under we are not comfortable with our inflation that is higher than 6%, and during these times RBI would generally increase the interest rates to bring down the domestic inflation. Okay, so these are the measures of consumer price index, so the CPI measure of inflation. Okay, now you'll see these are the data till late 2024, but now this has come down and we see the inflation rates of around 2 to 3%, at least till the last month. And this has given the RBI some of the wiggle room to decrease the interest rates. Okay. Now let's see what are the major reasons for high domestic inflation that India has experienced in the past years. And the topmost reason has been the food inflation. Now, what were the various reasons that led to food inflation in the country? The number one reason was supply chain disruption, and particularly during the monsoon season. During the monsoon season, we experience floods, breakdown of various roads, and because of this, the grains has not been able to reach the market. There has been a mismatch in the demand and supply, and this has led to a lot of food inflation. Okay, now the food or particularly agriculture is very seasonal in nature, and the majority of the production happens during the Kharif season and particularly during the monsoon. And therefore, it is very important to have very robust supply chain, which we have not been able to maintain. And therefore, this has led to at least spikes in food inflation during particular months of the year. Okay. The next major reason for food inflation has been the increase in global commodity prices, particularly edible oils and pulses. So in edible oil and pulses, we are more import dependent, and the increase of these commodities in the international market also affects us. So if the price of edible oils or the price of pulses increases in other countries, and it has increased due to various factors and also breakdown of supply chain due to wars or due to climate change, and these prices of these products has been increasing, and therefore these prices have increased in the domestic economy also. The next important reason is the increasing consumer demand. As more and more people become more prosperous and increase in the middle class of this country, they demand more food, more variety of food, and fresher food, and more luxurious food items like like avocados and dragon fruits and all that. And therefore, because of these increasing consumer demand, the food inflation has been rising. And another major factor, of course, is the climate change. Because of the climate change, the unpredictable weather event has increased, and this has led to destruction of many crops, and also a decrease in productivity. And because of these reasons, again, the supply has been uneven, and that has led to food inflation. So these have been the major reasons for increased food inflation in the country, and food inflation is the foremost reasons for overall inflation in our country. One of the major tools in the hand of the RBI is the monetary policy for controlling inflation. Now we know that the RBI, through its monetary policy, and the government of India, through its fiscal policy, tries to control the level of inflation in the economy. So first, let's look at the monetary policy of the RBI, and we'll look at the trends from 2019 onwards. Now, during this period, till middle of 2020, we see that RBI has been decreasing the interest rate. So it has decreased the policy rate, that is the repo rate, from around 6.25% to a low of 4%. Now, this was done so that the interest rates are decreased by the banks, and more people take out loans from banks and invest in businesses, invest in opening companies, factories, and other economic activities, so that our economy do not suffer. Because during the COVID period, and due to the lockdown, a lot of businesses closed and a lot of people lost their jobs. So there was a necessity at the time to decrease the interest rates to give a push to the economy. We were not really concerned with the inflation rate at that point, and our prime goal was to increase the economic activities in the country. So we see RBI adopting a very accommodative monetary policy during this time. Then the RBI kept the interest rate very low till at least early 2022. And during this period, the Indian economy was undergoing recovery from the shock that it experienced due to the COVID-19 and subsequent lockdowns. So the stance of RBI during this period was very accommodative. But then we see that RBI started withdrawing its accommodation during this period from early 2022 till late 2022, early 2023, because now the inflation had risen to a very high level. Also, the global inflation was very high. There was also the Russia-Ukraine war and other conflicts happening around the world. And because of that, the inflation had become too high for the comfort of the RBI and the government of India. And therefore, the RBI again raised to a high of 6.5%. Okay, and then during this period from early 2023 till at least early 2025, we see RBI maintaining a very high repo rate of 6.5%, because the global situation was very volatile. Even the domestic situation, although we were able to keep the inflation under control, there were a lot of speculations and a lot of volatility that still existed in the economy. And because of these reasons, the RBI kept the repo rate high. But then we have witnessed that at least in the last three monetary policy committees, the RBI has been decreasing the interest rate. So this interest rate has decreased three times by 0.25 percent, 0.25% and 0.5% in the last meeting. So this has decreased. So this has been the overall trend of monetary policy in the last few years of our country. All right. Now, if we look at the fiscal policy we see a very similar trend. We see that during this period the government of India took a lot of debt, and because of that the fiscal policy the fiscal deficit and other deficit increased. And this was particularly done to give a fiscal stimulus to the economy, because at the time of the COVID and the subsequent lockdowns, there was a need to give uh, more stimulus to the economy, increase the money flow in the economy so that more jobs are created and more businesses are run. But subsequently, we see that the government of India has adopted a path of fiscal consolidation, and slowly we have been bringing our fiscal deficit under control to 4.4% in the budget estimates of 2025-26. So overall, the trend with respect to both monetary policy and fiscal policy has been similar. During the COVID lockdown period, we did increased both our fiscal deficit and also decreased the repo rate, so as to assist the Indian economy towards more activities. But subsequently, we have been able to bring the inflation down by in the monetary policy, increasing the repo rate, and in the fiscal policy by decreasing the fiscal deficits and keeping the debt to GDP ratio under control. All right. So this brings us to the end of video 3. Thank you very much.